Ladies and gentlemen, welcome to Entrepreneurial Finance, the IPO, or the IPO as an exit mechanism. IPO is also an exit mechanism besides a trade sale and a buyout structure. And there's really very popular IPOs in the last years, especially this one. Facebook has gone public in May 2012 and the NASDAQ welcomes Facebook. That was what's happened, and Facebook realized, I think, 103, 104 billion valuation at that day, which was really kind of a large IPO, at least for these kind of companies. So they really successfully performed an initial public offering, an IPO. What is the advantage, disadvantage of an IPO as an exit mechanism? Well, first of all, think about an IPO. What happens in an IPO? In an IPO, about at the first public offering, about 20-25%, sometimes less. So Groupon was less because they couldn't keep the price. So 20-25% of the shares is being brought on the market. And the money is flowing back into the company as some liquidity. So the IPO, by the way, is the only exit mechanism which is financing for the company plus exiting for the others. However, exiting is not possible the first day. Exiting is only possible after a lockup period. But the advantage, it puts liquidity in the company. So there is some financing involved. Money is flowing into the company. Besides that, the standing and the reputation of the company is going to rise because the company is more known. The company has to make marketing before doing an IPO, so it probably gets a higher reputation, especially those companies which are privately held before, pretty unknown. In order to get potential shareholders, they have to advertise what they do, and so they advertise the company, and at the same time they also advertise what the company does, so the products of the company, which is good for their reputation. Normally, companies which are listed at the stock exchange are considered reputable companies. And it's probably also easier for those companies to recruit personnel. So these are advantages of an IPO. What's disadvantages? Well, people say you live from quarter to quarter. You have to do quarterly reporting, and other people can influence the company, especially people can influence the company you don't know. Everybody can buy the shares, and normally it's an anonymous market. Even if it's in Germany, the so-called Namensaktien, they are normally being dealt anonymously. So nobody cares about that. And there's rules for companies who want to buy significant number of shares. However, at the very first moment, you do not have any influence on that anymore. And these guys can influence your company, be it hedge funds, be it other funds who want to influence your company. So that might be a disadvantage. Having said that, these companies have to do marketing. This is also a costly process. So normally, companies which go public do a financing round before in order to cover the costs. And sometimes it happens that companies did some financing in order to do an IPO, and then the stock market broke down and they weren't able to do an IPO anymore, so they just had another financing round. So it's a costly and a stressful process, and is a process which is really much restricted by law. So you have to know the process. Actually, you have to have enough people on board that can help you with that process, and these people are also quite costly. Is this an interesting exit mechanism? Well, you can make money with an IPO. You saw it in the case of Mark Zuckerberg and Facebook. They were able to sell a lot of shares. They were able to collect a personal fortune. However, if you think about smaller IPOs with a venture backing, let's assume a venture capitalist has 30% in the company, bringing this company public. The first public offering is 20-25%, and after lockup period of 6 months, the venture capitalists start selling the shares. How easy it is to put shares on the market, significant number of shares on the market with a company which is not traded, which doesn't have a high trading volume. That's difficult. So sometimes an IPO is not really attractive because it's really hard to cash out, especially for a venture capitalist when everybody has the same lockup period. Because if the entrepreneurs after 6 months and the VC can start selling shares at the same moment, normally share price drops down because there's too many shares on the market and there's not enough demand for the shares. But that's a very special issue, so it is not easy to say whether the IPO is a good mechanism to do. What is a good moment for an IPO? Actually, you have to have an equity story. That's the main thing. So you have the so-called internal factors, which is the stock market, which is the economic situation. So the market has to be ready. If you run into a financial crisis, you can forget the IPO. And you have to have your own equity story. On the other hand, there's also external factors, and external factors is the economic situation, the stock market, is the market ready for an IPO, and so on. So there is many aspects the moment of an IPO. Most importantly, economic situation plus your own equity story.